Okay, you're welcome again. Today we are going to proceed with our class on group account. We started last week. Yes, last week. And today would be the second class on group account. So last week we set up a context around group account. We said the essence for which we are preparing group account is because of intercorporate investment, which is one entity investing in another. And we looked at reasons why companies invest in another entity or why one entity invests in another. You looked at series of reasons. And when one entity is investing in another entity, they do that either through equity or debt instrument. But our focus in this class is equity instrument. And when entities invest in equity instrument of another, it results in this set of or types of investments. Basically, these are what we want to look at, with the exception of this, because we have looked at it. It's covered in IFRS 9, IAS 32, and also IFRS 7. So our major focus is going to be these three. In fact, I'll majorly focus on investments in subsidiary and associate, because treatment for joint ventures is very similar to that of associate. These are the standards we'll use to cover the standards, to cover these types of investment. Then last week, we said the one called investment in subsidiary, that this one will arise when an investor acquires equity interest in an investee and his holding is beyond 50%. And the core thing is that it's not just about 50%. It's about the fact that when you have this type of investment, it gives you control. We explain what control is. And control is determined by power. Power. When you have the power to affect returns of an investee, you have control over that investee. When we look at the two elements of control, the power is what is the main thing there. All the other ones, yes, you have right to returns. Every other person has right to return. But that control is the power and your ability to use the power to affect those returns. We said, okay, what gives rise to power? Is it that when you buy shares and you have majority voting rights, or when you can demonstrate any of the following, when you're the one that can appoint, remove key management personnel, or any key entity that directs the relevant activities of the investee, or you can direct or veto the investee to enter into transactions in favor of the investor, or any other right as stated in the management contract. Then basically we came down to, okay, that when you have an investment in subsidiary, you're a parent while the investee is a subsidiary. We moved on to investment in associates. And for investment in associate, this one is when your holding in the investee is between 20 but less than 50%. Majorly, this type of investment gives significant influence. And this significant influence is just the power to participate in financial and operating policy. And this power in this case is either because you are holding voting rights of between 20% but less than 50%, or you can demonstrate any of the following that we mentioned. So when you have an investment in associates, that investee becomes your associate. And we went on to, okay, how do you then account for investment in subsidiary? We said when you have a subsidiary, when you have an investment in subsidiary, IFRS 10 requires that you have to prepare consolidated financial statement. And this consolidated financial statement is preparing financial statements of the parent and the subsidiary as if you are preparing that of a single economic entity, that no one will think it's that of multiple entities. They will think it's that of a single entity. But before we look at the technique in doing that, we looked at some key things that are also important. The fact that there are exemptions from consolidated financial statements, where even if you're a parent, that though IAS IFRS 10 says you have to prepare consolidated financial statements, but it also states that, okay, there are exemptions. You could decide to key into these exemptions and not prepare consolidated. And we looked at, I mentioned four of them for you, which you have to know. We also mentioned potential voting rights, that when you want to determine whether you have control, you need to consider potential voting rights like convertible debt, share options, warrants, and all of that. Any instrument that can convert to ordinary shares in the future, you need to consider them today, because since they can affect your ability to control, consider them so that you will know in substance whether you have control or not today. Then we looked at exclusion of a subsidiary from consolidation. Here, IFRS 10 is saying that don't exclude any subsidiary from the consolidated financial statement unless you have lost control over that subsidiary. You don't just decide and say, okay, I don't want to include this particular subsidiary in my consolidated account. Is wrong. You have to include it unless you have lost control over such a subsidiary. Then uniform accounting policy. We expect the parent and the subsidiary to have the same accounting policy. If they don't, the subsidiary must update accounting policy to that of the parent. Uniform reporting date. We also expect the parent and the subsidiary to have the same reporting dates. But if this is not feasible, if they don't, yes, they can still proceed with consolidated financial statements if the difference in reporting dates is less than 3 months. It's not above 3 months, I mean. So, but I mean, if it is not above 3 months, you can consolidate. If you're going to make adjustments for significant transactions in the book of the subsidiary. So any significant transaction that happen between those date difference, you need to adjust it, because ultimately we want the consolidated reports to represent the position at the date of the parent, at the date of the parent. So that's why we need to move any significant transaction that happens between the date of the parent and that of the subsidiary, adjust it, update it if it's possible. So the standard requires that we make such adjustments. Then basic consolidation procedure, which is, okay, how do we then consolidate? We have established that when we have a subsidiary, we have to prepare consolidated financial statements. Then how do we consolidate? We use a consolidation method. In fact, I can easily call it cancellation method, because the whole idea of consolidation is extremely straightforward. I'll repeat that again. Extremely straightforward. Consolidation is not hard, right? For those of you that have gone through skills level and you have done it before, good for you. For those of you that have not, so I was trying to do some revisions like I started last week. It's not difficult. So why is it not difficult? Because all we're doing is looking out for similar transactions, then cancel them out. So that cancellation, we call it consolidation adjustments, the canceling out, all that. And any item you did not cancel out, then you consolidate, you add it together with that of the parents. That's the whole idea. And when you look at your exams, which we are going to get to in a few weeks' time, you find out that I can focus more on adjusting the individual account with relevant standards, then consolidate, because consolidation itself is very straightforward. So they don't really ask deep question, testing you around consolidation adjustment and all of that. They don't do that anymore. They're advanced. So anyway, let's learn those cancellations. Now, for this cancellation, I would revise some of them with you today before we go advanced. There are majorly three key ones that you would find. Number one, which is the popular one, is the investment in subsidiary that appear in the books of the parents is going to be cancelled out against the equity in the books of the subsidiary. That's the popular one. Because in the parent account, the parent will have recognized that, okay, he has invested. Because he has paid money, he will put it in his books that he has invested, right? In the subsidiary, that same investment is represented by the equity of the subsidiary. The equity of the subsidiary. When you want to consolidate, you cannot add those two items in the consolidated account because they are the same thing. There is a transaction between the units. We cannot consolidate because it's the same. So we remove them, we cancel them out. Another one is that if you have trade receivables in the books of the parent and the same is represented by trade payables in the books of the subsidiary, cancel them out. They are the same thing. Additionally, any transaction between the two of them wherein they make profit, wherein they make income from one another, cancel them out. Cancel them out. So we cancel all that out on consolidation. They are much more, but the key thing is that any transaction between the two of them, cancel them out. Don't, because we believe you cannot be transacting with yourself. Make profit from yourself. The whole idea of consolidation is to have a financial statement that looks like that of a single economic unit. Then I showed you some questions. I also mentioned this really before I move to some questions that in the separate account of the parent, he needs to recognize that investment he has made at cost or in line with IFRS 9. And if he's going to apply the exemption from preparing consolidated financial statement, he needs to make some disclosures, which I also give to you last week. Then we look at the content of consolidated financial statement. And we looked at some questions last week. Yeah. Before we then started looking at this, I was showing you the items you cancel out and all of that. And if you noticed, I shared with you the notes, the working note for FR class, just so that you would have looked through it against today as revision, because those ones were teaching them this newly, so I've done all the solutions there. Last week I was just explaining that, okay, this one, this investment, you cancel it out against this equity, which is this and this. And I was showing it to you one by one. So what I will do for you today is let's look at this one that encompasses everything. Yeah, this particular one. Let me just use this to take you through some major cancellations so that you can see. And if you have any questions on this, then you can ask. So this is an opportunity for you to expose yourself, revise, and try if you can still remember any of these things. Yeah. Oh, so Charity said she thought it was a mistake. It wasn't a mistake, it was intentional, just so that you can use it for your revision. Okay. So now, if you look at this question, is symbol of financial position of PICO and ESCO as at 31st December 2017. Then they give us the accounts and they give us some details, right? Now, even without me telling you, right? If I start asking you, a lot of you will give me very correct answers in terms of what should be cancelled out. Because ultimately, we want to prepare consolidated accounts as of December. You see, even looking at the similar financial position, I, I can guess correctly that this investment, they have already told me is an investment in ESCO. I know I'm going to cancel it out against the equity of ESCO. I know I'm going to cancel it out. Number two, this is owned by PICO, owed to ESCO. I know I'm going to cancel them out. Those ones are clear, and that's how the very nature of consolidation is. They need to tell you the transaction that has been consummated between the two of them so that you definitely know what you're going to cancel out. Me looking at this statement of financial position, I know what I should cancel out. But they gave us some further details. What are the details? They said this parent, Pico, they said they acquired investment in ESCO on 4th January 2017 when the retained earnings of ESCO stood at 3,000. That is telling me that you see, this retained earnings of 14,000 I have here is the retained earnings as at the end of 2017. However, when I acquired the subsidiary at the beginning of the year, his retained earnings was definitely at 3,000. That goes to show that when I'm doing my cancellation, what I want to cancel out from this 14,000, from these retained earnings, because when you're canceling out investment against equity, equity comprises share capital and all reserves. When I'm doing that cancellation, I need to ensure that I don't cancel out the entire 14,000 based on this information given to me. That means out of this 14,000, only 3,000 was the retained earnings when I acquired the subsidiary. Only 3,000 is the transaction that is similar to this. Only 3,000 out of this 14,000 is part of what I paid for. The remaining 11,000 is a post-acquisition retained earnings. It happened after. It is not similar to this 15. So they therefore will never be cancelled out. It's a post-acquisition retained earnings. Furthermore, I was told that the agreed consideration was 15,000 cash and a further 5,000 on 31st December 2018. Now, so they are telling me that, okay, this 15,000 was recorded, so they agreed 15, but this guy promised additional 5 in December, and it's not attached to any condition. So we call this deferred consideration. Deferred consideration. So because it's a deferred consideration and we are reasonably certain it will pay, so of course we are going to recognize it in our books, but we cannot recognize 5,000 in our books because this 5,000 is an amount that will be paid in the future, right? What we need to recognize now is the value today, which is the present value of this 5,000. That's what we're going to recognize in our books. So apparently they haven't even incorporated it yet. It's not here. So we need to bring it in the books. And how do we then bring it? How do we introduce it in the books? So we need to look at that. This 5,000. Um, okay, let me juggle your mind a little bit. This 5,000, what would be which items will they affect in the books of the parent? No, it's not cash consideration. Which items?
Goodwill.
No. That's going too far. I mean, looking at this 5,000, which items will it affect today if I'm recognizing it in my books today? For my your network is not so good today.
I get maybe liability.
Say it again. Dummy.
Liability. Liability.
Correct. Liability. It's a liability because we're owing it, we haven't paid it. That's correct. Which other one? Okay, so if I say goodwill. Okay, so and I said that's going too far. So and the reason is that I needed trade payables, not trade payables. Trade payables is when you buy goods on credits. That's where you have trade payables. So this is a liability. We can just call it maybe deferred liability, something like that. Deferred liability is just the perfect name for it. And the other leg would be inside your investment in subsidiary. So under this account where you have 15,000, this investment, so you would add 5,000 to it because it's part of your investment. It's like you want to make further investment. That is what it means. But So you will add it to investment, while the other leg would go to deferred liability. The examiner can structure this amount in another way, whereby this amount is attached to a condition, where it is attached to a condition that they will say that I will give you further 5,000 if you make a profit of so amount at the end of the year or in the next 2 years. You know that's what type of liability is that?
Contingent.
Thank you very much. That's a contingent liability. But you know that what I taught you in IS 37 is that contingent liability are not recognized in the books because it's not probable that there will be an outflow of economic benefit and the amount cannot be measured reliably. But here, IFRS 10 allows us to recognize contingent liability in the books because now we know the amount, right? And is a subsidiary that I'm promising that amount, and I'll know when he makes that profit or not. So it's most likely probable. So IFRS 10 allows that you can recognize contingent liability in the books. So the same way I treat this deferred liability, it's exactly the same way I'm going to treat that contingent liability. So Ufoma, you're perfectly correct. But here, this one, since this is not attached to any condition, we can go ahead and recognize it. We would call it deferred consideration. Okay, so they give us cost of capital at 8%. Now, look at this. They said internally developed brand name, which was valued at 25 at the date of acquisition. So ESCO has an internally developed brand name of 25. Okay, so brand name is an intangible asset. And IS 38 says that when you have an internally developed, internally intangible asset, don't recognize it in the books. IS 38 do not allow internally developed intangible assets to be recognized in the books. That's why items like goodwill are not recognized in the books, brand name are not recognized in the books because they are internally generated, and a lot of them like that. And I38 says that the reason is that you don't know, we cannot measure the benefit it brings to you. We don't know, we cannot attach a benefit to it. That okay, this good name you have, how much has it made for you? We cannot attribute a benefit to it. And also we cannot also reliably measure how much you have spent to make up or to develop that good name, that reputation. We cannot. For that reason, say, no, don't put it in your books. I mean, there's a whole lot of debate around that. And I mean, that's not the story for today, but that's the position of IS 38. However, on consolidation, like we are doing here, you will see that now a parent wants to buy a subsidiary. And a parent is saying that he has acknowledged the fact that ESCO has an internally developed brand name of 25. That means they have both accepted that ESCO guy, you have a brand name that I'm accepting a value of 254. Therefore, that reason given by IS 38 that you will not recognize such an asset in the books has now been nullified because now we can measure it reliably and the parent is ready to pay for it. So when you have internally developed intangible assets, you can recognize it in the consolidated financial statement because the parent wants to pay because now we know the amount, we know the value of that asset. So we can recognize it in the books. So now, to recognize this in the books of the subsidiary, of course, because it's the subsidiary's intangible asset. So it's like you're going to debit intangible asset. You're going to debit intangible because it's an asset. So who can tell me what we're going to credit? If we debit intangible assets, what do we credit? What do we credit then?
It is the brand name we are crediting, sir. Brand name
Brand
account.
Okay, we will debit intangible. No, don't unmute. Let's talk. If you debit intangible assets, and you credit brand name, where will that one go? The brand name you are crediting, where? Is it expense?
It's
Is it
equity.
equity? Hmm. Michael, unmute back. Which that's intangible assets. That's that brand name you are crediting. Which element is that? Is it expense? Is it income? Is it equity, as Ufoma said? Do you agree with Ufoma? So Ufoma, you're close. You're very close. It's not parent equity, but it's actually a reserve. I wanted you guys to show some understanding. I don't want you to just be randomly calling items for me. You are the final level of ICAN exam. In the next few weeks, most of you, if not all of you, will become chartered, right? You need to understand these things, right? Since there is an asset that was not in my books before, now it is now in my book. So, and it's an intangible asset. So you definitely debit it. I did not buy it. They did not gift me. It's something that was there and somebody is not ready to pay for it. That becomes like is similar to revaluation surplus. It's like a fair value surplus. It's like we fair value that and we got this value. So while you're debiting the assets, you're going to be crediting a fair value surplus, which is a reserve, and it goes to equity, right? So which is why I didn't disagree with Ofoma when she said equity. I wasn't sure she understood which item of equity belongs. And it is not parent equity, charity, far from it. So in the books of ESCO, two accounts, assets and fair value reserve or fair value surplus. Additionally, we're told that there have not been changes in the share capital or evaluation surplus since that date. So they're still speaking of course, the two, majorly the subsidiary, that its ordinary share capital and valuation surplus hasn't changed since that date. That date here in this context is the date we acquired subsidiary. Then that goes to show that this evaluation surplus is also part of what the parent has paid for. Since they are telling me it hasn't changed since the date of acquisition, that means it's this entire amount that was there. It's this entire amount that we paid for. So we're going to cancel it out. We'll cancel it out. It's a similar transaction to this investment. Okay. Additionally, he said at the end of the year, ESCO sold goods to the value of 1,000, sold invoice Pico for goods to the value of 1,000, and Pico had sent in payment in full, but ESCO did not receive the payment. So interesting. So if I go to the account, I should be able to see a trace of that. Okay, owned by ESCO, Pico, 5,000. Owned by ESCO, 4,000. Okay, fine. So ESCO is saying that I'm expecting 5,000 from you. That Pico, I'm expecting 5,000 from you. ESCO, in the books of Pico, Pico is saying, ESCO, I only owe you 4,000 because that's the because here. That Pico said he has sent money, but ESCO did not receive it. Good. So that means even though these are transactions between the two of them, but 1,000 worth of that transaction has not been completed. So it's an uncompleted intragroup transaction. We cannot cancel them out. We cannot cancel them until it is consummated. So for that reason, we're only going to cancel out this 4,000 against 4,000 here. The remaining 1,000, we call it cash in transit. We are going to consolidate it. And I'm calling it cash in transit because the examiner told me that this guy sent money, sent payment. That's a cash in transit. And the other variation to that could be goods in transit. So the examiner could give you a scenario of goods in transit. So watch out. So I was told that it's a good policy to value NCI at full fair value. I'll show you something to further explain valuation of NCI. It's very straightforward. Nothing serious around that. And the value NCI at 9,000. Okay, fine. So I just wanted to use this question to wrap up a lot of things for you. So if I want to solve this, and note anything you don't understand, just let me know so that because after this, I'm moving to the when you have more than one subsidiary, which is what your syllabus really wants you to know, not all of this. So the first thing we need to do is let me establish. I don't even know the holding of Pico in Esco. All I know is that this guy bought 10,000 shares and Esco has 12,500 shares because the nominal value is 1 era. So 12,500 divided by 1 era is 12,500 shares. So I think let me note that down that Pico acquired 10,000 divided by 10,500. That okay. Here's your calculator, please. No one. You kidding me? You came to SBR class without calculator.
80%. 80%.
80%.
80%. So that means, of course, this means the NCI will have how many percent? This means that NCI has 20% equity interest in ESCO. Okay, I've sorted that out because I wasn't given directly in the question. If I was, I won't bother writing this over again because I will just refer to the question. Now, having been informed that, let me just follow through with these guys to do my cancellation. They gave me these retained earnings at the date of acquisition. Usually we call it pre-acquisition retained earnings, which is part of what the parent has paid for. It will be cancelled out. Also, the purchase consideration is in cash and different consideration like I've explained. So I need to sort that out. So my purchase consideration, which is the money the parents pay to acquire the subsidiary, is in two folds. There is the cash consideration, which is 15,000, and there is the deferred consideration. Now, deferred consideration, we need to discount it to present value because all this I'm doing, I need to know what's the value at the date of acquisition. So, and that will be 1.08 raised to power minus 1. And is it 1 minus 1? That's minus 2. Minus 2 in the sense that the date of acquisition is 1st January 2017. And I'm saying that I'm going to pay you 5,000 in December 2018. That's in 2 years' time. That's 2017 and 2018. Now, since I'm looking at 2 years' time and I want to know the value today, so I bring it back to 2 years. So I will get a PV, the different consideration, I'll get the present value. Then I multiply that by the future value, which is the 5,000. So what would that give us, please? Oh my God.
4,287.
Okay, that's the present value of this. So that's like 1 plus, this is 1 plus r raised to power minus n times the future value. Okay, so ultimately, how much am I looking at? I'm looking at 19,287. Okay, now, so that I won't forget, anytime we discount present value, anytime you see this purchase consideration, note that is at 1st January 2017 as at the date of acquisition. Because that was when I paid this 15 and I brought this one back to present value. But when I want to consolidate, I'm going to be consolidating at December 2017. So I need to get the value at December 2017. Why am I creating a new working for it? Because as at 1st January 2017, the value up there was 4287. As at December, at 1st December 2017, I will have unwind the discounts through what we call finance costs. So, and in unwinding the discounts, it's basically you do 8% times the opening value, the value at the beginning, which is this. So if you remember, we did this in provision. If you remember, we had revised. Anytime we discount present value, as you move to the future, you need to unwind the discount through finance costs, right? So who can give me, what are we looking at?
343.
343. Now, when you add it to the 4287, what are we looking at? And that should be 4630. Is that correct?
It's correct, sir.
Okay. Now, you see this P&L, this guy, this finance cost that we are adding here, the corresponding entry to adding it to this liability, because this is a liability here. It's a deferred liability, deferred consideration. Now we are unwinding it, we are crediting it. You see, the corresponding debit will for this finance cost will eat P&L straight on. It will eat P&L. While this guy will come on under, we are paying it next year under current liability. It's a liability, a deferred liability. Okay, now that we have sorted that end, I've sorted this. Now, let me move to this brand name of 25. Like I mentioned to you, the internally generated brand name is a new asset as a result of valuation, right? So with this guy, I will debit my intangible assets, right, which they will call brand name. That to 5. Then I credit a fair value surplus. And since this guy was derived at the date of acquisition, so this fair value surplus is a reserve. It will be a pre-acquisition fair value surplus, and it's part of what the parent is paying for, so it will be cancelled out. This particular reserve will be cancelled out because it was developed, it was discovered at the date of acquisition, and they must have included the amount and the pricing of the consideration. So it will be cancelled out on consolidation. It's this particular credit here. Why, of course, this one will be consolidated. That's the asset part of it in the books of the subsidiary, of course, is the subsidiary's asset. So that's this one. So there have not been changes in the, okay, so this is just telling me that the valuation surplus is also a pre-acquisition reserve. And this is telling me there was a cash in transit. This, okay, that's all. So now let's do some cancellation. Cancellation will usually result in goodwill majorly. So I will have my consideration transferred from workings 2. I got 19,287 from workings 2 up there. Then this should cancel out against the equity of the subsidiary. But I think I set up a template for you that when you have a scenario where the parent acquired only 80%, that means there will be a non-controlling interest that you should also factor in. And the examiner already gave me the that's 9,000. This is where the NCI is measured at full fair value. It's not in all cases. In some cases, it will be measured at proportionate share. I'll show you some differences very soon between them, but here they've given us the value of the NCI. So we'll put the value of NCI at 9,000. So that means therefore that, okay, this is the 100% they paid for as far as as far as the subsidiary is concerned. So if we add these two, I guess we're going to be looking at 28,287, if I'm correct. Then we cancel it out against the equity of the subsidiary, which we commonly call net asset acquired. I'm sure you know that equity is the same thing as net assets. So when I say we are canceling out against equity, you know that is the same thing as the fair value of the net asset acquired. It's the same thing as the fair value of the net. So they can call it any of the names, but it's common practice to cancel out from the standpoint of share capital and reserve. So what's the share capital of the subsidiary? 12,500. 12,500. Then would have the reserves of the subsidiary because it's equity. So I have reserve here, and they already told me that this 25 has been there since the date of acquisition. So it's part of what we paid for. So we cancel it out. So we call it pre-acquisition revaluation surplus. 25. However, for the remaining parts of the equity, which is this retained earnings, this 14,000, only 3,000 of it was there when we acquired the subsidiary at the date of acquisition, of course. So that's the pre-portion. So we have pre-acquisition retained earnings, and that's how much? 3,000 given, right? Okay. Finally, I remember that this fair value surplus that we credited as a result of this internally generated brand name, this reserve part is a pre because this brand name was created at the date of acquisition, which is part of what we paid for. we have to cancel it out. Let me just simply call it fair value surplus. Can put in brackets brand name so that they know that I know that is as a result of the brand name. But it's actually a fair value surplus, it's actually a reserve. So 2,500. Okay. When you sum total this, then what are we looking at? If I'm correct, please confirm. So what's my goodwill?
$7,787.
Thank you. Okay, so I have cancelled out and the balance is goodwill. I know that the reason why we call it goodwill is because for the 100% value of the subsidiary, the consideration of 28,287 was considered payable or paid. When we fair value or looked into the value of what we're paying for, it's just 20,500. The only explanation for reasons why we are paying above is basically because we believe there is an asset in the subsidiary that is not a physical asset that we cannot see, but is valuable. But we value it. We know it will bring in more. We call that type of asset goodwill. Goodwill. So when you pay more, so on business combination, when you pay higher and above the fair value of the asset of an investee, that excess amount you paid is called goodwill. So it can be the reverse as well. We don't expect that reverse. We don't expect that you pay below 20,500, for example, for this company. We don't expect the company to even accept any amount below it. So you see, let's say this guy paid 20,000 for 20,500 worth of assets. You see that difference in 500, no doubt, is a gain to this parent, is a gain to it. And that's why IFRS 10 calls it gain on bargain purchase. So it's a gain. He puts it in his books and add it to its retained earnings. That's what the parent does. But IFRS 10 says that when you have a scenario where a parent is making a gain on acquisition, when you have a gain on bargain purchase, it says that the parent needs to look at the component of that calculation correctly. The parent needs to look at how it has measured the asset of the subsidiary. It needs to look at how it has measured the NCI. It needs to also look at how it determined the amount it paid to the subsidiary, because we don't expect to have a gain on bargain purchase. We don't expect that this will be lower. So I need you to take note of that. Now, the next thing is after cancellation, the only thing left to cancel is this 5,000 against this 4,000, and there's no need for workings for that. We can easily just start adding all the others together. However, in order to make our lives easy, these retained earnings here, when you want to consolidate it, you cannot simply do 13,000 plus 14,000 because we have canceled out 3,000 from here. The remaining 11,000, yeah, you cannot just add it to retained earnings also, because there is a portion of it that belongs to NCI because we only have 80%. There's a portion that belongs that we need to share to NCI and all of that. The same thing as this 22.5. We didn't cancel out the whole of this 12.5 because there's a portion that belongs to NCI. So that's why we need to usually do workings. One is to show the workings of how we derive the consolidated retained earnings of which is a consolidation of PICO and ESCO retained earnings. So as per the question, which is at the date of consolidation, retained earnings of PICO is 12,000, this guy 13 and 14. So this is 13,000 and this is 14,000. I take out pre-acquisition retained earnings, which we calculated as 3,000 from the question. This one, this 3,000, and they give us in the question as well. So the remaining 11,000, that's post acquisition retained earnings. Okay, now this remaining 11,000, we then share it to be shared between the parent and the subsidiary. But before I do the sharing, let's not forget this liability, this finance cost that I said is going to go to P&L. And is a liability, since this deferred consideration is a liability of the parent, so all this is going to impact the parent books. So this 343 finance cost is going to the parent as an expense. It goes to P&L, but since we are not preparing P&L, let's impact it through retained earnings. So let's get the group share, I call it group share of ESCO post retained earnings, which is the group has 80% times 11,000, which is 8,800. So let's sum it together. So if you do 13,000 minus 343 plus 8,800, what does that give us? 13,000 minus 343 plus
21,457. 21,457 naira.
okay, good. So finally, which is working 6. I will have non-controlling interest. And based on what we have set up there, the value of our non-controlling interests was 9,000 is given to us. He's also going to have share of ESCO post retained earnings, which is 20% times 11,000, which is 2,200. And this gives a total of how much? 11,000.
11,200.
Okay. So now we can prepare our consolidated statement of financial position as at year ended 31st December 2017. Okay, so assets, non-current assets. The first item here is PPE. If you add these two together, it gives me how much? 45,000. PP gives me 45,000. The next item here is investment. which has been cancelled out. So, and when we did the cancellation, we had a goodwill of 7787. So that's working is what? Working is 4. So goodwill 7787. Then inventories. If we add these two together, that's 5,000 or 4,500. B 5,500. 5,500. That's under my current assets inventory. 5,500. Owned by Pico was cancelled out against O2 Esco. So there was a balance of 1,000 here, which you call cash in transit. So we have cash in transit, which is 1,000. Then receivables. If I add this 8,000 plus 3,500, that's 11,500. So receivables 11,500. Then cash at bank, it was 1,000. Okay. So what's my total assets? Can somebody please help me add all this?
$71,787.
71,000.
787.
71,787. Okay. My equity and liabilities, equity, ordinary share capital. So what's my ordinary share capital? That will be that of the parent because this is cancelled out. $22,500. Then after the ordinary share capital, evaluation surplus is just this 6,000 because this has been cancelled out. So evaluation surplus. $6,000. Lest I forget, I almost forgot anyways. I almost forgot that intangible assets, that brand name. Or I think 2,500. So let me increase this by 2,500. Let me increase this 7187 by 2,500.
74,287.
Okay. After the revaluation surplus, the next item is retained earnings. And I already did the workings for that. which is working 5. And we have 21,457. So for my retained earnings, okay, then my current liabilities, this has been cancelled out. Then I have trade payables of 85. Trade payables of 85. Then, lest I forget, my deferred liability, I think is working 3 or so. No, working 2. 4630 is 2. 4630. Yes. So, what do I have as my total equity and liabilities?
63,087.
63,087. What have we omitted? Okay, Senate. We omitted this one. We omitted non-controlling interests. This is working as what? This working 6 and this working 5. Working 5. How do we got this one? Working 6. So NCI, the balance, it was 11,200. Yes. So add 11,200 to this. Let's see what it gives us. 11,000 to 63,087. Let me see. Should give us 74,287. And that should be my total equity and liabilities. So, do you have any questions? Any questions? Okay. Now, I was telling you about cancellation, and I've shown you that question we solved should have exposed you a lot to some things that you need to note. Another one is intragroup profits, and this intragroup profits can either be made from transactions between the parent and the subsidiary, either sales of goods or sales of assets. So when they sell goods between one another, they make profit. Such profits that is recognized on those goods must be eliminated. And also, even that transaction between themselves, if one has recorded one of the transaction as, let's say, sales that is sold, another recognize it in purchases, you need to cancel it out. We cannot consolidate that. That's the whole idea around consolidation. That's the only thing you need to look out for. Every other thing is straightforward. So when they consummate transaction among one another, cancel any form of profit. So I will use this opportunity to also show you this so that you would also have an idea of it as well. So if you look at this question, Pico acquired 80% of the shares of ESCO on 1st January 2017 when the retained earnings of ESCO stood at 5,000. And they gave us similar financial position on these dates of the two companies. And majorly, they said during the year, ESCO sold goods to Pico for 25,000. The profit to ESCO being 20% of selling price. Now, so at the end of the reporting period, 7,500 of these goods remain unsold. I was not told that at the same date, Pico owed 6,000 for goods bought, and this debt is included in trade payables of Pico and receivables of ESCO. And ESCO is valued, NCI is valued at 9,000 on the date of acquisition, and are asked to prepare consolidated statement of financial position. So if you look at this, let me just show you the cancellation and all of that here. So for this now, the only thing here is there was a sales of goods between these two guys. In their books, this one will have recognized 25,000 as sales. ESCO will have recognized 25,000 as sales. Pico will have recognized 25,000 as purchases. We can't see that because we are preparing statement of financial position. However, they said the profit to ESCO was 20% of selling price. So ESCO made a profit of 20%. Now, that profit he made, we need to eliminate it from two places. We need to eliminate it from two places. Now, in the books of ESCO, that profit will have gone, it's sitting is in these retained earnings. We need to remove it, that profit from here. And secondly, in the books of Pico, that profit will be inside his inventory. It will be sitting inside his inventory. Except they have told us that he has sold it out. If he has sold those goods, if Pico has gone ahead and sold out those goods, then fine. Then fine, that profit becomes realized from the standpoint of ESCO. And which is what they are telling me here, that these 25,000 goods that was sold to Pico, only 7,500 of these goods remain unsold. That means my profit that I want to cancel out is now to the extent of these unsold goods. The portion that has been sold, that one is now beyond transaction between parent and subsidiary anymore because the parent has gone ahead to sell it out. So whatever profits that ESCO has made from the portion that has been sold out is deemed realized because it has gone out of the group. The only portion that we believe is still a profit that needs to be cancelled out is to the extent of these unsold goods. Additionally, this 6,000 intragroup transaction that was in their trade payables and trade receivables also needs to be cancelled out. Now, for this cancellation now, if I want to consolidate, I will get my investment in ESCO, cancel it out against the equity of ESCO. So that cancellation usually results in goodwill. So if I get my consideration transferred, which is how much? 23,000. Since I have only 80%, that means there will be some guys called non-controlling interest, which has 20%, and they are valued at 9,000. If I add these two together, it gives me 31,000. I would cancel it out against the net assets, which comprises the ordinary share capital of the subsidiary, which is 15,000, against the pre-acquisition retained earnings, which I was told is 5,000. That's the pre-acquisition retained earnings of the subsidiary. So the two now is 20,000. So my goodwill is 11,000. That's my Hawkins one.
That is 12,000. The first one is
The
32,000.
figure is 32,000.
Oh, thank you very much. 12,000. Then I would want to quickly sort out my consolidated retained earnings of PICO and ESCO. So as per the correction, all the retained earnings of 22,500, 11,000. 22,500, 11,000. I will remove the pre-acquisition retained earnings. What was the pre-acquisition retained earnings? Said it's 5,000. Remaining how much? 6,000. And I was told that this guy sold goods, ESCO sold goods to Pico, and he made some profit. So that profit needs to be eliminated. So unrealized profits. And that profit, they told me, is 20% of the goods that was unsold. So out of these 25,000 goods, so only 7,500 remains in the inventory of Pico. So the unrealized profit is to the extent of these unsold goods. So what's 20% of this? That's 1,500. But the challenge is this: we are removing it from whose profit are we removing from? Is it from Pico or from ESCO? It will be from ESCO because I made the profit. It was the one that sold. So we need to remove it from ESCO's profit. But you also need to remember that you also need to remove this profit from the inventory of Pico. Since Pico is still retaining 75, and this 75 includes a profit of 15. So that has to be eliminated as well to have a balanced account. So after eliminating this, we then have a profit of 45. Then group will take their share of ESCO's retained earnings, which is told me is 80%. They have 80% holding. So 80% times 45. What would that give us?
3,600.
3,600. So, what was the addition to 22,500?
26,100.
26,100. Now, my non-controlling interest, what's the value of NCI derived? 9,000. We also have share of ESCO retained earnings, which is 20% times 4.5. This 4.5 here. And that's how much? 900. So we're looking at 9,900. So, and that's basically it. So my consolidated statement of financial position as at year ended 31st December 2017. Assets, non-current assets. So my first item here is PP. Addition of these two gives me 60,000. Then my investment in ESCO that was cancelled out, resulting in a goodwill of 12,000. That's workings one. Here's one. Goodwill of 12,000. Then I have my current assets. Addition of these two gives me 35,000. So, but that 35,000, don't forget to remove the unrealized profits because inventory is already inside of here. So that's 33,500. If I add these three together, I get my total. So how much is my total assets? 72,000 plus 33,500. 105,500. So my equity and liabilities. Equity. I have my ordinary share capital. What's my ordinary share capital? That's 50,000. Because this has been cancelled out. Even if it's not fully cancelled out, the balance is now NCI. So this is 50,000. Then my consolidated retained earnings, which is workings 2. This one, this 26,100. Then, lest I forget, my non-controlling interest, which is workings 3. And we got it as 9,900. 9,900. Then my current liabilities, which is 19,500. Current liabilities 19,500. So can you sum it up for me? Let's see what we have.
It balance 105,500. 105,500 is balanced.
Okay, so my equity and liabilities. 105,500. Now, you see, another thing they can sell apart from goods is for them to sell assets among themselves. So the issue of selling assets among themselves is the fact that they will now be carrying the asset at a profit load. And asset is depreciated. So they will have calculated depreciation on profit as well. So in addition to eliminating or removing that profit, which is deemed unrealized as far as the group is concerned, we would also need to remove the depreciation that has been charged on that profit. We need to reverse it as well. It has to be reversed also. So that's what we do for when there are sales of assets. So you don't need to be cramming debit days, credit days, and all of that. Just understand what we're doing. So when they make profit on sales of assets, eliminate it. The depreciation that has been charged on that profit load, remove it. So that's the only thing. Yeah, you can see that they sold a plant of 5,000 to Pico for 6,500. So there is 1,250 profit. So that 1,250 profit, whatever, just calculate 10% on it. That's the excess depreciation that should also be removed. So very similar. Let me show you the adjustment very quickly. So to consolidate here, we need to cancel out this 23,000 against this equity. So let me call it workings 1. Let's say that's goodwill. So my consideration transferred is 23,000. Non-controlling interest is 9,000. Addition of these two gives me 31,000, which I will cancel out against the net asset acquired, which is my equity. I'll have the ordinary share capital of the subsidiary. What's the ordinary share capital of the subsidiary? 15,000. 15,000. Then pre-acquisition retained earnings, which is 5,000. So this gives me 20,000. So my goodwill is am I making the same mistake? So again. So this 12,000, that's my goodwill. Then secondly is my consolidated retained earnings for Pico and ESCO. So as per the correction, retained earnings of this 22,500, this 11,000. Remove the acquisition retained earnings, which is 5,000. We are left with a post retained earnings of 6,000. Now, the unrealized profits on sale of assets, which is 6,250 minus 5,000. 6,250 minus 5,000. Who made the profits? It was ESCO that made the profit. So we remove it from his retained earnings because ESCO sold to Pico. So it was the one that made the profit. Additionally, the excess depreciation which is 10% of the profit load that they will have charged because they depreciate assets. So they will have charged extra depreciation. Since we are eliminating the profit element, then that extra depreciation charge should also be eliminated. So that's 125. And the asset is with the parent. So we are going to be, so since depreciation is usually an expense, this is like reversing an expense. That, okay, we have charged, we have removed 125 before that we are not supposed to remove from our earnings. Okay, now I want to put it back there. So this one will come in as an addition to the parent's profit. And finally, we'll get group share of ESCO retained earnings, and the group has 80% of what will remain now? 6,000. That should be 4,750. You confirm? 4,750. Yeah. So 80% times 4,750. What does that come to?
3,800 naira. 3,800.
It's 3,000. Correct. Okay. Then what's the total?
1,500 plus 125.
Huh?
That's 800. Okay, 26,425, correct.
Okay.
So it's correct.
So finally is the non-controlling interest, and the value of NCI from the workings up here is 9,000. You also have a share of ESCO retained earnings, which is 20% times 4,750. What does that give us?
950.
Okay,
950.
you get 950. Okay, so we have 9,950. Okay, so PICO, consolidated statement of financial position, as at ended 31st December 2017. Assets and current assets. Okay, so PP addition gives me 60,000. See, this 60,000, don't forget there was a profit that is in the books of the parents that needs to be removed. And also there was an excess depreciation that was charged that needs to be added back. So we need to make sure we make those two adjustments. So that gives me 58,875. Then my second item is investment in ESCO, but it was cancelled out, giving us a goodwill of 12,000 in workings one. So Now, the current assets. This 35,000. Now my total assets. So what's the addition of all this?
One 105,875. 105,875.
Okay. Now, equity and liabilities. Ordinary share capital. What's the ordinary share capital of the parent? Because that of the subsidiary will have been cancelled out. This 50,000. Then consolidated retained earnings. That was working two. How much does it give us? 26,425. This one. 26,425. Then non-controlling interest. That was working three. What does it give us? 9,950. Okay, then my current liabilities. Which is this?
19,500. What should be 19?
Which is 19,500.
19,500.
But just so that we don't forget. Okay. Ignore it. There's nothing there. That's okay. Let's add this together.
Nice. 115,875. Balance now.
Total equity and liabilities is what? Okay. So now it's possible this question here, you can look at it yourself. This is just teaching you how to calculate pre-acquisition retained earnings. Just look at it and see if you can try it. If you have any challenge, let me know. Let me give you a clue to it. But it's very straightforward. And this fair value adjustment is the same thing as the one where we had what is it? Where they revalued this one, they revalued an asset. Okay. And also similar to that fair value surplus that I did for that intangible asset. Okay. So, but for this one, it was a non-current asset that they revalued. And they revalued it at the date of acquisition. That means this is the revaluation surplus would be a pre-acquisition evaluation surplus, which is this 11.5. And also, they say there is a depreciation that we're supposed to charge that they have not charged. So that has to be charged. So goes to P&L, then the other leg, you remove it from the non-current asset. You can look at it yourself. And there are some questions here that I want you just to practice. These are revisions for you. Just practice it. I'll solve it with the skills guys because these are their past questions. These are their past questions. So these I'm doing is just revisions for you. So you see, what the examiner wants you to know for you guys. What the examiner wants you to know is not all of what I've been, is not what I've been talking about really. I just that you may not understand what the examiner wants you to know if you don't have an idea of those other ones that I've mentioned. It's actually a scenario of a complex group. That's what the examiner wants you to know. So, and this complex group is like 3 or 4 scenarios that we need to teach you in the next 3 classes. Yes, you're able to finish it in the next 3 classes. The first scenario is where a parent acquires more than one subsidiary directly. He acquires them directly. So they call this federal subsidiary. This name is irrelevant or whatever. So you don't need to. Do you understand what has happened? He acquires more than one subsidiary, or where a parent acquires a subsidiary and the subsidiary acquires another subsidiary. So we call this sub-subsidiary. The name again is irrelevant, but just so that I can easily refer to them. This one is long. This one is long. So there are some scenario where the parent acquires a subsidiary and the subsidiary acquires another. And the parent too will now acquire some portion in that other one. I will show you that as well very soon. Another complex group is where a parent acquires its holding in a subsidiary or in an investee in stages or piecemeal. How do you inspect piecemeal? Is it piecemeal or piecemeal? What is this? So he acquired it piecemeal, little by little. So another one is where a parent disposes its holding in a subsidiary. Another one is where a parent acquires a foreign subsidiary. Another one is then consolidated statement of cash flows. So these are what you actually, any of this is what you find in your exam. Last diet, I think it was this. Was this consolidated statement of cash flows? So For you to know this very well, so you really need to know all of these other ones, which is why I just took my time. That we should just look at it, just for you to have an idea. So it's not left to you to go and revise it. You can pick up, you go to YouTube, go to FR. All of these things I've taught you, I actually taught it in more detail for FR students. So if you don't understand everything I'm saying, then you can go there and look at it, watch the videos. I think to be like 4 videos or thereabout or more. But if you understand it, I mean, I've actually shown you all you need to know as a foundation for where we are going. So you're good. So that you not waste too much time looking at that one. You can use that time to watch other videos at your level. So the first scenario is where a parent acquires more than one subsidiary. I won't waste time on this because it's exactly the same thing as what I've done before. So this is the same as the simple consolidation. So the parent will need to cancel out its investments against the equity of each subsidiaries. So we just need to cancel out his holding. Is when you want to consolidate, so if he acquires X, he cancels out his investment against the equity of X. If he acquires SS, he cancels out his investment against the equity of SS. So that means we'll have like two goodwill that you're going to add together. It's pretty the same. And every other thing just consolidates and all of that. But the one that you would check your past question, you likely be tested on is where a parent acquires a subsidiary and the subsidiary then goes ahead and acquire another subsidiary. That's that's the main one. So we're looking at a scenario where let's say Pico. Let's call him Pico. Why is this thing? Hmm. Okay, ships. Okay, let's say Pico. Let me put it straight like this. Pico acquired 80%. Let's say 80%. Yeah, 80% holding. Let's say 80%. They acquire 80% holding in ESCO. And ESCO again now acquired, he went ahead to also acquire, let's say 75% holding in another company. Let's call that one SSCO. So this is what I'm talking about. Where a parent acquires a subsidiary and the subsidiary acquires, let me write it in full, where a parent acquires equity interest, so that's acquires equity interest in a subsidiary, and subsidiary acquires equity interest in another subsidiary. So now, what's special about this? Really nothing. No. So the only thing is this. Is the parent that is preparing consolidated accounts. So because it's the parent that is preparing consolidated account, then you need to identify the fact that the parent has acquired equity interest in ESCO. It's fine, but the fact that ESCO has gone ahead to also acquire equity interest in another entity. And don't forget that since PICO has 80% in ESCO, it means that everything ESCO has, PICO has 80% in it. So in addition to the 80% PICO has in ESCO, PICO, by virtue of ESCO's transaction, also has an interest in SSCO because PICO has 80% of everything ESCO has. So PICO also have 80% of 75% that ESCO has in SSCO. Because of that, PICO would have to consolidate both ESCO and SSCO. They become its subsidiaries. But in ESCO, it has 80%, it consolidates 80%. That means there will be NCI of 20%. In SSCO, it will consolidate, it has 80% of 75% in SSCO. So that goes to show that for consolidation, the most important thing is for us to determine effective interest of PICO in SSCO, because our interest, not only PICO, of PICO and NCI, because NCI too will have interest in it. So it's clear that PICO has 80% in ESCO. That one is clear. But what does PICO has in SSCO? PICO has 80% of 75%. Tell me what the answer would be. In SSCO, 60. It has 60%. That means automatically NCI has 40% effective interest in SSCO. So since PICO has 60% in SSCO, so who has the remaining 40%? Is the NCI. Is the NCI. And how did I get this NCI? Who can break down this NCI of 40% for us? Okay, yeah, Jakub. Go ahead, please.
Yes, so I'll be thinking that the first NCI will be 20% of 75%. Then the rest of 25% that none of ESCO and PICO has. So that's 15% and 40%.
Thank you very much, Jacob. That's absolutely correct. So even though that analysis is not important, that breakdown is never important. I just want you to just have an idea. So don't forget, we said that anything ESCO has, PICO has 20% and 80%. So who has the remaining 20%? NCI, of course. So indirectly, through the fact that ESCO has 75% in SSCO, NCI has 20% of it. Because everything ESCO has, NCI has 20% of it. So if you do 20% of 75%, that's 15% indirectly. And directly, since NCI has, I say NCI, since ESCO has 75%, that means the guy has the remaining 25%. So of course, directly and indirectly, if you add these two together, this guy has 40% in which is this. So I said this analysis is not important, and I mean it. Somebody will ask you of this, but I mean it just makes sense for you to understand it for your use in the exam. If the need ever arise. I've not seen it arise, but it's good you see through it. So of course, if you can determine what PICO has in SSCO, the balance automatically belongs to NCI. So that was how I was able to figure out this 40%. That since PICO has 80% of anything ESCO has, and I'll be able to derive that at 60%. So automatically the balance of 40% is what NCI has in SSCO. So when you're consolidating, this is what will guide us to consolidate SSCO. Another dimension to this is a scenario. So another scenario to this is very similar to this. So let's say PICO, using the same scenario, let's say PICO has the same 80%. 80% in SSCO. In ESCO, and ESCO has 75% in SSCO. However, in addition to this, which shape can I use now? Yes, use this. In addition to this, let's say this guy This guy has this shape is not working. I want to do Pico also has holding in SSCO as well. Okay, let's say this guy Pico also has let's say 20% in SSCO. Say he has 20% in SSCO. So in this case, if Pico wants to prepare consolidated accounts, he will need to consolidate both ESCO and SSCO. For ESCO, it's clear that he has 80%, NCI has 20%. But for SSCO, what does he have? Number one, anything ESCO has, he has 80% of it. So by virtue of ESCO holding, he has 80% of SSCO, 80% of 75%. In addition to that, he now also have 20% in SSCO. So from here, the effective interest of Pico in SSCO, it has indirect interest, which is of 80% times 75%, which is, I think we got 60% earlier on. And directly, from his direct holding, he has how many percent? He has 20%. So altogether, in SSCO, he has 80%. They don't need to tell you before you know that what non-controlling interest has here is 20%. So when you want to consolidate SSCO, then you need to know that Pico has 80%, NCI has 100%. So even though you don't need this, I just need you to be able to visualize it. So breakdown of NCI holding in SSCO. So two things, Number one, indirectly, anything SSCO has, anything ESCO has, NCI has 20% of it. So NCI has 20% of 75% in SSCO indirectly. And I think computed that up there as 15%. And also directly, since ESCO has 75% of SSCO and PICO has 25% of SSCO, making 95% gone, the remaining 95% belongs to NCI. So the remaining 5% belongs to NCI. And 15 plus 5, that's this 20%. But again, this analysis, you would not need it, but you just need to understand that something like that do exist. So you will have easily gotten this 20% as the balancing figure. Since parent has 80% in SS score, automatically NCI will have the remaining percentage. So that's that for these two. So next on Saturday, we're going to solve questions on these two very quickly. It's very straightforward. There is nothing special there. Then I will then explain this to you. If you have the time, we're going to, if you guys are responding fast, then I will explain when he acquires his holding in piecemeal. I would move on with that. Then the next time we're meeting on Wednesday, if you can address to, I think I should be able to address this one. These two, maybe we'll probably finish these two. Then we'll be left with just this. So as soon as I explain all of this, we are done with the major part of group account. So along the line, I will need to also revise associate with you and statement of profit or loss. Those ones are very straightforward, extremely straight. There's nothing, is also cancellation for associate. But for associate is simpler because it uses equity method. So when you have an associate, you don't consolidate, you just take a share of his profit. So it's relatively easier for associates. So let's stop here for tonight. Then on Saturday, we'll solve these three questions. Question 1, question 2, and question 3. We would resolve those three questions and also move to piecemeal acquisition. Okay, so thank you very much. If there are no any questions, I'll see you on Saturday. Bye.
Thank you.
Thank you, sir.
You're welcome.